Welcome to another episode of Quest for Twice. Today is November 15th. Today I'm going to cover the earning updates from several mega technology companies. But first, I will review energy transfer. There were many changes to energy transfer's 2024 outlook. For the full year, its EBITDA is still centered around $15.4 billion. The debt went up to $59 billion due to recent acquisitions of WTG. Market cap was 58.5 at $17.1 per unit. I estimate its 2024 DCF will still be $8.8 billion or $2.57 per unit because of the dilution effect. Its full-year growth capex came down from 3 months ago to $2.9 billion, and forward dividend is still $4.4 billion. So if we add the capex and dividend together, that's 7.3. So it's 1.5 billion less than the full-year DCF. Energy transfer still has a lot of firepower for dividend increase, unit buybacks, or buying other business, or all of the above. At the valuation level, its EV over EBITDA is 7.6 using 2024 EBITDA guidance. And the price over DCF is 6.7. Both are higher than 3 months ago because of the unit price increase. Now let's look at the digital advertising business. The main players include Google, Meta, aka Facebook, and Amazon. So in the graph, the gray bars are the advertising revenues from Google, and the orange bars above are the Google Cloud revenues. We can see that Google makes most of its revenue from advertisement. The red line is a Google service ops margin. We can see in the third quarter of this year, it held steady from previous 2 quarters. The other lines were the year-on-year advertisement growth from Google, Meta, and Amazon. We can see that all 3 of them had a peak in the second quarter of 2021. That's due to the pandemic and the reopening effect. Then all 3 had a dip in the middle of 2022, with Meta and Google briefly had a negative revenue growth in the second half of 2022. Then both rebounded, especially Meta. In the first quarter of this year, its revenue growth was almost 30%. And Google ads grew to over 10% in the trailing 4 quarters. And Amazon ads peaked in the second half of last year, then gradually decelerated. Now it's holding steady about 20%. To better understand the drivers of those troughs and peaks, let's look at Meta, especially its growth by region. So as shown in this figure, the red bars at the bottom are the APAC revenues from advertisers located in the APAC region. And the gray bars are revenue from USA advertisers. and the yellow bars were European advertisers, and the green bars on top were the rest of the world advertisers. So we can see Europe had a significant revenue contraction in 2022 because of the Russian invasion of Europe. It had a strong rebound to over 25% in the second half last year, then moderated and stabilized around 22% in the most recent 2 quarters. For American advertisement, it had a negative revenue growth in 2022 and early 2023 because of the Apple iOS privacy change. Then it resumed growth in 2023, and in the most recent quarter, it actually grew over 20%. That's highest growth rate in the last 2 years. The green line is the APAC region revenue growth. We could see a slight dip below zero in the fourth quarter 2022, then strongly rebounded in 2023 and peaked over 45% in the second half of 2023. That's driven by the removal of COVID lockdown in China and the rest of the East Asian countries in 2023. That pent-up demand manifested itself in 2023. Then it normalized in 2024. If we look at the APAC region revenues in 2024, we can see that from quarter to quarter, it's growing, but at a much slower pace. A side note, Meta's Reality Lab is still losing significant money. For trailing 12 months, the operation loss was $16 billion. So that's more than the revenue Meta makes from APAC region in a single quarter. Both Google and Amazon are significant public cloud providers. So let's switch gear to look at the public cloud revenue and growth. So in this graph, the yellow bars are the quarterly revenue of AWS, and the gray bars are the quarterly revenues of Google Cloud. So we can see AWS is about 2.5 times the size of Google Cloud. Azure is in between, doesn't disclose the exact revenue numbers of Microsoft Azure. However, all 3 companies disclose their year-on-year growth for their cloud business. So we can see a significant cloud revenue growth in 2021. That's because of the pandemic lockdown and the business switching their activities online. So had a huge demand for cloud services. Then after the reopening, all of them start to decelerate quickly, especially with the so-called rationalization. Amazon's AWS revenue growth bottomed out just over 12% in the second half of last year. Then it rebounded to almost 20% in the most recent 2 quarters. In general, Google and Microsoft clouds grew faster than Amazon, partly because they are smaller players and can grow from a smaller basis. The trends are similar. After COVID reopening, both experienced a decline in 2022 and bottomed out in 2023 and resumed growth in 2024. Both Google and Microsoft Azure are going faster comparing to the steady growth experienced by AWS. But it's worth noting that all three companies' growth rates in the most recent quarter was still 15 or more percentage points below the peak growth during the COVID pandemic. We know that the COVID pandemic was a once-in-a-lifetime event in terms of switching business from offline to online. The recent growth is likely partly attributed to a lot of investing and excitement in generative AI. However, in terms of growth rates, they don't compare to the COVID-induced growth for the public cloud companies. Of course, we haven't seen the peak of the current growth wave. However, if they don't match the COVID level growth peak, then the stock price of all three companies become susceptible to pullbacks. Why did I say that? Because all these companies invest a huge amount of money in the recent quarters because of the AI excitement. So as shown in the figure on the right, I plotted the capex by the three major cloud companies plus Meta, because Meta is also a major AI player. So we can see in the most recent 6 quarters, collectively, those companies invested very quickly in the server build-up to support the generative AI and other AI applications. The growth rate was even faster than the growth during the pandemic. But as we seen from the last slide, the cloud revenue growth rate are still significantly less than the peak growth during the COVID. So the key question is, will they generate adequate return on all that investment related to AI? So we need to see accelerating cloud revenue growth coming up. Otherwise, the return on the recent investment will be less than the return during the pandemic. And that is the reason I stated that the stock price can be under pressure if the return turns out to be lower than expected. Next, let's look at Amazon's business by segments. I've already covered the advertisement and AWS. So this graph shows the revenue growth rates for all Amazon business segments. Overall, its Q3 revenue grew 11% from last year. That's up from 10% in the second quarter. That growth was driven by ads and AWS. The third-party sales were holding steady, and the subscription growth increased slightly. Both are hovering around 10%. The actual sales of goods by the first party sales, that's an online store as well as physical stores, were growing more than 5% in Q3. That's a slight pickup from the second quarter, likely reflecting the overall health of American consumers. Now let's summarize. In this graph, the x-axis is the operating income growth of those four major technology companies from the last 4 quarters. And the vertical axis is the revenue growth of these companies from the most recent 4 quarters. The dashed yellow line is Amazon. So we can see that it's fairly flat. The point with the data label is from the most recent quarter. So we can see that its revenue overall is decelerating slightly, but the ops income has decelerated a lot. That's because Amazon had a cost-cutting effort in 2023. Because it runs a very low-margin business, then any cost-cutting can increase the ops margin significantly, and that's why the ops income growth was significant. But now the cost-cutting effect is wearing off. A similar story is Meta, which is the thick red line. We couldn't see that its ops income is decelerating very fast from over 150% in the fourth quarter last year to only 26% in the most recent quarter. On top of that, its revenue growth also decelerated to below 20%. That's because of all that trough and peak effects in 2022 and 2023 related to the Europe as well as APAC regions. For Microsoft and Google, because their ops margin were high to begin with, with the cost cutting, it increased their ops margin. But in terms of percentage, it's not that significant. That's why we see those points are somewhat clustered together. It's interesting to note that Google basically had its revenue growth hovering around 15%. And Microsoft had a revenue growth deceleration from 18% to about 16% over the last 4 quarters. It's important to note that Microsoft bought Activision in the fourth quarter last year. So that's why the easy comparison will be over when the fourth quarter results come out in early 2025. And I expect a significant deceleration of ops income and revenue growth for Microsoft in the calendar fourth quarter of this year. Overall, in terms of revenue growth and profitability as measured by ops income growth, I haven't seen any strong sign of the most recent significant investing in data centers paying off. That's something I plan to watch closely in the coming month. This concludes this episode of Quest for Twice. Until next time, happy investing.